This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 448 was produced on October 3rd, 2024. I'm Eric Townsend. Forest for the Trees founder Luke Gromen returns as this week's feature interview guest. We'll talk about the dollar, inflation, monetary policy, China, energy, precious metals, and much more.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, October 2nd, 2024. The December S&P 500 futures down 33 basis points, trading at 57.60. The September market rip is showing signs of exhaustion. We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The U.S. dollar index up 67 basis points, trading at 101.60, reversing strongly off the lows, particularly driven by the reversal in the euro. The November WTI crude oil contract up 59 basis points to 70.10, back to the top end of its 1 month range, driven by increased geopolitical tensions. We'll take a look at that chart in the postgame, and Eric will have the EIA inventory data. The November RBOB gasoline up 102 basis points, trading at 199. The December gold contract down 60 basis points, trading at 2669, fulfilled the 2700 target and now consolidating off the short-term high. Copper up 356 basis points, trading to 465. A dramatic bullish reversal continues. Uranium up 180 basis points to 82.20, continues to show signs of life, and the U.S. 10-year Treasury yield up 2 basis points, trading at 380. The key news to watch this week is the Friday's jobs numbers, and next week we have the FOMC meeting minutes and the U.S. CPI and PPI inflation numbers. This week's feature interview guest is Forest for the Trees founder, Luke Gromen. Luke and Eric discuss the Taylor rule and the Fed's policy shift, the impact of hedge funds on the U.S. Treasury markets, the market outlook, and more. Eric's interview with Luke Gromen is coming up as MacroVoices continues right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Forest for the Trees founder Luke Gromen. Luke, it's great to have you back on the program. It's been a long, long time. You know, I want to start with what the heck is going on with China, because I've been trying to get my head around this all year. I've been asking lots of our feature interview guests to explain the China situation. And the explanation has been, everybody thought China was going to recover and the stock market was going to recover, and it just didn't happen. Well, that was only 2 weeks ago. I swear, I'm not making it up. Now it seems like China's outperforming everything. The Chinese equities are overbought, outperforming the S&P on the year. What just happened? What's driving it? What's the bigger picture, and how does this fit in?
I don't know if I'm the right person to talk to on that. I
think you're the perfect person to ask for that question.
So for me, my question, I've said this in a couple the video appearances that I do, what have you, is I couldn't figure out what China's plan was. To me, we know China tends to not do anything without a plan behind it. And so I couldn't figure out we knew overwhelming Western consensus was China's making a mistake by not stimulating, et cetera, et cetera, et cetera. And sort of China's uninvestable and China's collapsing. And I knowing that China tends to have a plan, knowing that clearly the economy was weakening meaningfully and they weren't stimulating, et cetera, I was sort of grasping for possible reasons, one of which I came to was maybe they're engaged in basically a pain contest, which was to say, you know what, we're not going to stimulate. And the problem with that is if we don't grow, that's going to force you to cry uncle first, USA. You're going to have to cut rates. You want to weaponize the dollar against us? Great. We just won't stimulate. We'll take pain. And we'll see who ends up going first. And that was kind of my working theory and, loosely held. So fast forward 2 weeks ago, we have Powell come out and surprise most of Wall Street by doing 50 basis points and promising 50 more by year end. Dollar weakens, asset prices rip. And then we have China follow up 4 days later doing what they did. And so now it starts to look like one of two things, which is either Powell cried uncle first, which gave China the ability to sort of then finally do the stimulus without having to do stimulus with the yuan at, a key week threshold. The yuan has obviously rallied meaningfully versus the dollar from, July through today. And that gives China the breathing room. Or the U.S. and China are coordinating on some level. We've been writing since November of last year when Treasury went over to Beijing and talked about China needs to basically raise their costs, right? Well, they raise their costs by raising the currency, by weakening the dollar. So we've been saying for 10 months, starting last November, that it looks like that Yellen and the Chinese are working on some sort of deal to strengthen the yuan, weaken the dollar. And maybe this is part and parcel to that basically sort of a point has been reached where, okay, they agreed to something and we're moving in that direction. Okay, so now the Americans can cut rates and weaken the dollar and the Chinese can do what they're doing, which is stimulating. And I think to maybe the most important takeaway that I took so far from the stimulus is the yuan rose against the dollar on this. That is, if you would have asked 100 people, including me, hey, China comes out last weekend before they did this, China's going to do a big stimulus this week. What's the yuan do? I would have said, and all other 100 probably would say, yuan falls sharply. And instead, the yuan rose pretty notably. And so that points to sort of a capital repatriation type dynamic that I don't think a lot of people are talking about yet. I don't even feel that strongly about it yet. It's just been too short. But that's how I'm thinking about it as a framework. I could go either way. I could be pushed either way on it. I don't have a strong feeling on it, but that's kind of the framework I'm looking at about it.
Well, Luke, I certainly agree with you that there's something more to this China situation than meets the eye. I'm not sure what, but my spidey senses say there's more to this picture than we've seen so far. Let's move on to something that you wrote about in a recent piece called Tree Rings from Forest for the Trees. You talked about the Taylor rule and the fact that it would actually have called for, before this latest policy move from the Fed, before the 50 basis point cut, if you'd applied the Taylor rule, it would have prescribed a hike, not a cut in U.S. rates. So the Taylor rule has generally been very well respected by the Fed. How is it possible that they're kind of, doing the opposite? No, we're not political, but we're just going to do the opposite of what we used to believe in.
Exactly, right. There was a great post by Vincent Deluard, my friend Vincent Deluard, on X shortly before the Fed meeting a couple of weeks ago, and pointed out that the Taylor rule suggests the neutral policy rate would call for a 25 basis point hike. And instead, the Fed cut by 50 basis points and arranged the Fed dot plot to suggest another 50 basis points of cuts coming by year end this year. And if I knew nothing else other than the Taylor rule said they should be hiking 25 and they cut 50 and promised 50 more, I'd say buy gold, buy Bitcoin, buy stocks, sell the dollar, and sell long-term treasuries, particularly against gold, Bitcoin stocks. And that's sort of exactly, not sort of, it is exactly what happened. And the question is why? And to me, the why is crystal clear. I think there is clearly some, in the very short run, some politics. We know the Fed doesn't like Trump. Per Dudley's comments going back in 2019, where he wrote a Bloomberg op-ed saying that the Fed should act to basically kneecap Trump and make sure he doesn't get reelected. But away from the tactical politics of that, which are what they are, I think there's way more important politics that Wall Street, it's sort of the boogeyman they don't want to talk about, which is the Fed's doing this because they have to. The fiscal situation of the United States is dictating this, which is to say, because the Fed raised rates so aggressively, with U.S. debt to GDP as high as it was, U.S. what we call true interest expense, which is just the gross interest expense plus the current portion of entitlements, it's approaching 100% of U.S. receipts for fiscal 2024, ending today. And critically, it was 120% of July receipts, and it was 150% of August receipts. Now, July and August are sort of off months because of just how the corporate tax calendar goes, et cetera. But the point is that the Fed screwed up this time by not letting inflation run higher for longer. Had they done that, they would have allowed U.S. debt to GDP to get down to 70, 80, 90%. And had they done that, they could have raised rates aggressively without pushing the true interest expense of the United States above tax receipts. But because they didn't do that, now the fiscal situation dictates they have to cut rates to get interest down because they can't cut entitlements and they can't cut defense. And so they need to cut rates. And in my opinion, that is the elephant in the room political reason of why the Fed is cutting when the Taylor rule says they should be hiking is they have to finance U.S. government deficits.
Luke, you and I have been talking for years about this risk that, oh my gosh, what if foreigners who have massive holdings of U.S. Treasuries continue divesting themselves of those U.S. Treasury holdings, and it puts the U.S. into a really serious fiscal crisis at some point where it can't fund itself. But hang on a second, Luke. Foreign holdings of U.S. Treasuries just hit all-time highs? How's that even possible?
It's possible because the U.S. has gone from financing with very patient creditors like central banks and Japanese pensions and insurers on the margin to financing with very fickle creditors who are housed offshore. So the headline was U.S. Foreign holdings of U.S. Treasuries hits all-time record. And that's about as deep as most people got. So we called up the major foreign holders of U.S. Treasuries report publicly available. And what we found was Japan is still the number one creditor, but in the latest month, they actually sold and they've been selling all year. China's still the number two. They too sold in the month and they've been selling all year. The number three creditor, the UK, has been, up a bit on the year. It's very odd that the UK is the third largest creditor of the United States because they are a twin deficit nation. They are having, arguably, their fiscal situation is at least as bad as ours. And so how are they possibly, with running twin deficits and having a debt problem of their own, buying our debt? And the answer is of course, the London Financial Center means it's largely investor and hedge fund buying. So hedge funds are very different creditors than central banks, much more fickle. They want to make money. Central banks tend to buy to manage to a political outcome over longer periods of time. Okay, so the number three creditor of the United States, United Kingdom. Number four creditor of the United States, Luxembourg, country most Americans can't even find on the map. Not a very big country, very nice country. Tax haven. Again, more fickle creditor. The number five creditor of the United States of America, Cayman Islands, population 68,000. And they actually, Cayman Islands, when we have record holdings of foreign treasuries in the latest data, July, by far over half of the foreign buying in July came from the Cayman Islands, tax shelter, hedge funds. So you've got the most powerful country in the world not financing its debt with its patient creditors or with foreign central banks, but with the 3, 4, and 5 biggest creditors are the UK, Luxembourg, and Caymans. Number 7 is Ireland, which are just U.S. corporation tax havens. So you've got basically, you've gone through this period where you are going, the United States since 2014 has gone from financing with global central banks who are very patient. They don't buy for profit. They buy for political reasons. And there was sort of a virtuous cycle of trade where we buy more stuff from Japan and China. They buy more treasuries, wash, rinse, repeat. Now they're selling their treasuries, Japan, China, OPEC, and instead UK, Luxembourg, Caymans are where we are marginally financing, which again is fine, except hedge funds don't want to buy long-term paper. They want to buy bills because they want to make money now. They don't want to take the duration risk. So the United States is increasingly seeing its foreign financing, marginal foreign financing, shift to more and more fickle creditors at shorter and shorter durations. And that is driving secular volatility in the treasury market higher and higher. We've seen that over the last 5 years. And it's also secularly inflationary, because if you finance it 10 years, it very much sterilizes the government spending. However, T-bills are much more cash-like, right? A cash at the end of the day is just a 0% yielding bond of zero duration, right? That it says Federal Reserve note on every US dollar in your pocket. A note is just a bond. A dollar bill is just a 0% yielding bond of zero duration. So that's cash. T-bills are sort of the closest relative of cash. They are short-term paper with a yield. But the more you finance in bill markets, the more secularly inflationary it is. It's stimulative. You can use that more easily as collateral. And so what you're seeing is the U.S. being forced to shorten where it finances with more and more fickle customers who want to make money. Hedge funds need to make money now. And it also leads to this one last really important point, which is hedge funds tend to have monthly mandates, and they tend to buy treasuries on a levered basis, particularly the relative value hedge fund trade for treasuries. When volatility picks up, what hedge funds tend to do is degross, delever. And that's volatility anywhere. So if VIX goes up, if equity volatility goes up, and they're running a levered treasury book, they're going to degross a bit. That's just what their models tell them. And so that gets into this pro-cyclical dynamic now, where as equity volatility goes up, treasury volatility goes up. And then we've seen this play out 4 or 5 different times over the last 5 years. Ultimately, it forces the Fed and Treasury into a position where they have to continually the Fed put everybody who has been looking for in equities is actually in Treasury volatility. So the Fed and Treasury have had a put on Treasury volatility for the last 4 or 5 years, and it continues. And the release valve for that are equities, basically. So basically, it keeps liquidity high, it keeps equities high, and so that's a lot of detail. But this shift within the U.S.'s foreign holdings of treasuries is a very, very powerful shift. Global central banks have not bought an incremental treasury in 10 years. We're financing now with hedge funds in the Caymans, Luxembourg, and UK.
So putting this in perspective, Luke, what you're saying is you and I have been talking for years about the fact that there's a perilous situation, which is the U.S. Debt is basically in the hands of a bunch of foreign lenders that might not always want to continue lending. That perception that they might divest, you're saying that is in fact happening. It's an illusion that it's going in the other direction. And the reason for that illusion is that hedge funds, hot money, and we don't know for sure that it's hedge funds, but money that's coming from hot money jurisdictions like the Cayman Islands, probably hedge fund money, is coming into this market in short duration, and it's the kind of holders who, just as they come in quickly, might leave quickly. So that begs a couple of questions. Why are these hot money traders suddenly buying so many T-bills? And more importantly, what's the catalyst that might cause them to just as suddenly start selling them? Because that would be the situation, if I'm understanding you correctly, that would take us from the illusion of the lending problem not being as bad as we thought to the realization that it was actually much worse than we ever even imagined.
Well, I think the reason they're doing it is multi-pronged. Some of it is obviously rates are higher. But there's been a number of different very interesting articles about the size and scope of the relative value basis trade. So basically, there is an arbitrage available where hedge funds can sell treasury futures and buy cash T-bills. And if you pick up a few basis points, but if you lever that enough, it's a great little moneymaker. And so there was an article last September where a senior hedge fund at one of the biggest hedge funds in the world was quoted that relative value hedge funds are routinely putting anywhere from 100 to 500 turns of leverage on this, which you can do because those aren't treasuries. That's not debt. Those are risk-free collateral. And so why not? And like I said, ultimately, that is fine. that can go on and on and on. And where the release valve to that, you will see hiccups like we saw in, say, 3Q22, when the U.S. Treasury Move Volatility Index spiked as stock markets sold off and rates rose. You saw the Treasury volatility hit levels that the creator of the Move Index, Harley Bassman, said was telling you that the Fed had completely lost control of the bond market effectively. That's what the Move Index, I think, hit 160 or 170 in September 2022. And very quickly, Powell didn't come in to change anything, but Yellen did. Yellen ran down the TGA, injected dollar liquidity, and the dollar went from 114 in early October 2022. The dollar fell at a 25% annual rate over the next 3 to 6 months, which is a huge rate for the dollar. And that sort of stabilized things. We saw it again in 1Q23 when Silicon Valley Bank and Signature Bank had their issues. Stock markets sold off sharply. Treasury markets sold off sharply. Treasury volatility spiked. Again, Fed came in. They did BTFP, which was basically bailing out bank treasuries at par rather than making the banks take the losses on their treasuries. They injected dollar liquidity. Stock markets responded higher. 3Q23, same thing. We had Treasury volatility pick up, stock volatility pick up. And as soon as U.S. Treasury volatility, the Move Index hit 130, in the next 10 days after that day, 7 Fed governors came out and said that the bond market has done our job for us. Literally like they were reading from a script, basically saying we're done. And we're done raising rates. And Yellen, shortly thereafter, came out and shifted, surprisingly, a significant portion of Treasury issuance to the front end, into the bill markets where the demand was. And that calmed things down, dollar liquidity injection. So we've seen this pattern play out multiple times, and it's instructive in terms of what does it mean that the U.S. has shifted to the front end. It doesn't mean that the world's going to end, Treasury markets to collapse, the bond vigilante, whatever. What it means is that unless the U.S. government, Fed and Treasury, are willing to stand aside and let Treasury volatility not just rise to levels that imply the U.S. Losing the Fed losing control of the bond market, but then stand aside as yields rise, et cetera, then all that it means that the United States is now marginally financing with hot money is that the Fed is going to have to take the other side of that in a hot money way. Same thing with Treasury, Fed and or Treasury. It doesn't matter who does it. But what does that mean in plain English? It means they are going to manage, and they have been managing, to Treasury volatility. As long as Treasury volatility stays low enough, Treasury markets function, and as Treasury markets function, it's fine. But they have repeatedly injected whatever dollar liquidity is needed to keep Treasury markets functioning. They've been doing it for 5 years since the repo rate spike. So it doesn't mean you can't have declines in other risk assets, but what it means is that anytime Treasury market volatility picks up, equity volatility will pick up, and then the Fed and Treasury will come in right away with more dollar liquidity, and they'll stabilize the Treasury market, and stocks will go higher. And we've seen that pattern repeat. Like I said, we saw it in 3Q19, we saw it in 1Q20, we saw it in 3Q22, we saw it in 1Q23, we saw it in 3Q23, we saw it in April of 24. And so I think it's going to keep happening.
Luke, lots and lots of people focus, if not obsess, on the question of U.S. national debt. They think about it in terms of how big the principal repayment number is. I think what's actually more important is the flow dynamics of this question, not how much however many trillion we're up to now in U.S. debt, but rather it's not so much the can you make the mortgage payment, but what happens when you get the notice that the payment went up. Rather than focus on the amount, let's talk about Treasury roll rates. How many treasuries does the U.S. have to issue just to service paying back the ones that are maturing?
It kind of ties into this point of why are we issuing at the short end? We highlighted in this recent report that back in the third quarter of 2014, the Treasury Borrowing Advisory Committee, or TBAC, they do a quarterly report, and they have a chart in every quarter showing the weighted average maturity of marketable U.S. debt outstanding. And in June of 2014, the weighted average maturity, or WAM, was 68.4 months. And it was projected to go from 68.4 months in 3Q14 to about 83 months by 2024, where we are today. As John Lennon once sang, life was what happens to you while you're busy making other plans. Reality is that global central banks stopped growing holdings of treasuries the very next quarter after that report came out, and U.S. weighted average maturity has basically never risen from that point. It's basically been flat with a dip down and a dip back up and come back to this level. So we're still right around 70 months when, remember, the plan was in 2024 to be at 83 months. And the question is, what happened? Well, what happened is what we just described, which is when central banks stopped growing their marginal holdings, and then we had to shift to the front end to where the demand was. And that brings us to the point of this role dynamic we talked about back in 3Q23, in October of 23. Then Treasury Secretary Jack Lew gave a testimony to Congress around the debt ceiling. He said, quote, "Every week we roll over approximately $100 billion in U.S. bills. If U.S. bondholders decided that they wanted to be repaid rather than continuing to roll over their investments, we could unexpectedly dissipate our entire cash balance. There is no plan other than raising the debt limit that permits us to meet all of our obligations. Let me remind everyone, principal on the debt is not something we pay out of our cash flow of revenues. Principal on the debt is something that is a function of the markets rolling over." And so when we saw that, someone flagged it to us in 2018, that quote, and it's like, wow, 100 billion a week. That's a lot. And so we said, all right, well, that's a gross issuance number, right? That's not a net issuance number. It's just gross, but they're rolling over principal within that. So we said, all right, well, we said that's the roll. What's the roll in 2018, in 3Q18, when we saw that? And what we found was that the $100 trillion a week roll that Jack Lew testified to Congress to in October 13, by October 18, was $200 billion a week. Huh. Wow. A lot more being done at the front end, presumably because debt's going up. There's not enough demand at the long end because central banks aren't buying anymore. And so they're having to basically issue where the demand is, at the front end. Okay. Again, that's fine. There's a very predictable set of context that generates, but again, it's fine. So we hadn't looked at it recently, and so we decided to, again, from the TBAC report, what the gross issuance is, and we were astonished by what we found, which is that the roll that was, gross issuance, that was $100 billion a week in 3Q13, that was $200 billion a week in 3Q18, it's now over $500 billion a week. That's a CAGR, a compound annual growth rate, of over 16% in the past 6 years. And again, it's the same issue. It's that we are issuing more and more debt more and more frequently at the front end because the debt is getting so big, and the sort of big, patient, nonprofit motivated creditor, central banks, haven't bought any U.S. Treasury bonds in 10 years. And so again, this is fine. This doesn't mean, the world's coming to an end, but this is like payday lending kind of stuff. And it has, again, a very specific set of contextual implications, which is issuing more and more bonds at shorter and shorter durations with more and more fickle creditors in a world where the Fed and Treasury are not allowing Treasury volatility to go above a certain level. The more you issue at the short end with fickle creditors, the more you have to make sure Treasury volatility stays low. And the more you keep Treasury volatility low, the more you got to keep equity vol low. And the more you got to keep equity vol low, the more you're going to see earnings multiples, equity market prices, and inflation and nominal GDP growth head higher, sort of ad infinitum, until you drive stocks in the economy high enough that your tax receipts are really reducing your expenditures relative to your receipts.
Luke, needless to say, you're preaching to the choir. I couldn't possibly agree more with you. But you know what? There's going to be some of our listeners who probably feel like, for crying out loud, Eric and Luke have been talking about this for years and years. And let's face it, so far, despite the fact that all of this stuff really is happening, the declining demand for U.S. Treasuries hasn't hurt the U.S. financial situation yet. So is it really going to happen, Luke? And if so, when's it going to happen? And what would you say to those skeptics who are just saying, hey, you guys have been talking about this stuff for years?
To me, it's people saying that are simply not understanding what they're looking at in terms of the symptoms, right? You have to understand the symptom of what you're talking about. A lot of those people tend to think, oh, I'm going to see the long end spike and I'm going to see stock market crash. No, you wouldn't. No, you wouldn't. Not necessarily. Not if Treasury shifts all the issuance to the front end. And so, like I highlighted, that gold over the U.S. long-term Treasury bonds has outperformed long-term Treasury bonds by 7% per year since Jack Lew gave that testimony in October 2013. The S&P 500 has outperformed long-term Treasury bonds by 12% per year, CAGR, since Jack Lew gave that testimony in October 2013. The NASDAQ outperformed long-term Treasury bonds by 19% per year, CAGR, since Jack Lew gave that testimony. And on face-peeling volatility, Bitcoin has outperformed U.S. Treasury bonds by 74% per year, CAGR, since 2013, since Jack Lew testified to Congress about this rule. And so that's what I would say to people saying, oh, you've been talking about forever. But like, yes. And as long as you keep looking for the symptom of the problem to be a spike in long-term rates and a crash in stocks, you're never going to see it. You're never going to make it, as the Bitcoin people like to say. What you would see if the U.S. government deals with this problem by shifting issuance to the front end, capping Treasury volatility by whatever means necessary when that spikes up, is what you're going to see is neutral reserve assets like gold and Bitcoin crush the incumbent primary reserve asset, long-term treasuries. Because remember, long-term treasuries are simply a competitor for gold. Treasury is a long-term bond reserve asset with a coupon, risk-free. Gold is just a 0% yielding, risk-free bond with finite issuance and infinite duration. And so, there's a chart I've highlighted for clients recently. Charles Gabb was on your show, Eric, on May 10th, 2018. And he said, I'm watching gold over the long-term U.S. Treasury bond, because if gold is going up against the long-term Treasury bond, that means inflation is coming back and the Chinese are winning and the U.S. is losing. And if the opposite is true, then the Americans are winning and inflation is dead. And since he said that, if I use ZB as my long-term Treasury future number, the day he said that on your show, the ratio was 9. Today, the ratio is 21. So you've had gold massively outperform since he said that, and massively outperform since Jack Lew gave that testimony. So I always just kind of laugh. People say, well, there's no signs of the stress anywhere. But you're looking for the wrong stress. Sovereigns don't go bankrupt by having rates explode and the stock market crash if they can print the money, if they're the reserve currency, if it's a fiat currency system. Where you see it is you see them basically implementing de facto version of yield curve control, except it's really not yield curve control yet. It is Treasury market vol control. And the release valve's going to be asset prices crushing gold, stocks, Bitcoin, crushing long-term Treasury obligations of the U.S. And you're going to see inflation pick up by the most in 40 years, which we did. And you're going to see a shift to the front end, which we've done. And so all of these things, I think, are the things you have to be watching for the real symptoms of what's occurring.
Since you brought up gold, the competitor to long-term treasuries, let's also talk about a perspective you shared with your readers recently on Forest for the Trees, which is the gold-oil ratio breaking out. Please explain why the gold-oil ratio is significant from a macroeconomic perspective. And also, I've noticed that gold is breaking out against several non-dollar currencies. Seems like there's a big picture here. There's more to this picture than meets the eye, so to speak.
From a big picture perspective, the gold to oil ratio is a temperature gauge on the health of the sort of petrodollar system, if you will, right? So a low gold to oil ratio means gold, which is the primary competitor of long-term treasury bonds, is low in price. Oil is relatively high in price in the denominator, low gold to oil ratio, and higher oil prices are good for OPEC, and OPEC recycles into treasuries, supporting treasuries. And so all else equal, under the system that existed from, call it 71 and until, I don't know, 2018, 2020, 2016, low gold to oil ratio meant everything is great. High and rising gold to oil ratio is a pressure gauge suggesting that system is breaking down. Higher gold prices means more competition for U.S. treasuries. It means more investors seeing inflation coming back. And relatively low oil prices means relatively low OPEC flows back into treasuries and surplus U.S. dollar assets, which means the U.S. needs other sources of financing. And so a high and rising gold to oil ratio is a sign of stress. So what we've seen is since Putin began putting significant amounts of his reserves into gold in 2008, when he started that, the gold to oil ratio was, I don't know, about 7-8 barrels of oil per ounce of gold. And it's now 39. So gold has risen, what is that, 5-6x, 5.5x in oil terms in the last, call it 15 years. Now, why has this happened as a practical standpoint is we have seen, and you and I've talked about a lot, Eric, over the years, oil is beginning to be priced outside the U.S. dollar increasingly. China in particular, more recently India, a few others on the margin. And as that happens, nobody trusts you on debt. China has a closed capital account with one exception, gold. You can get gold in and out of China at the Shanghai Gold International Exchange. China also has offshore renminbi clearing banks in London, gold hub, Switzerland, gold hub, UAE, gold hub, Singapore, gold hub, Hong Kong, gold hub. So there's ways to net settle any renminbi imbalances, which tend to be only with energy and commodity producers at a wide variety of places around the world that are also gold hubs. And we've seen people talking about this. Jeff Curry, most notably, former head of Goldman's commodities desk for a long time, talked about petrodollar recycling is becoming gold recycling, that oil surpluses are moving into gold. More recently, we saw this dynamic significantly accelerate after the United States sanctioned Russian FX reserves in 2022. Since that happened, global central bank buying of gold surged to over 1,000 tons a year. Every year since, it's continuing at that pace. And so you're having effectively this new emergent system where oil in particular, commodities more broadly, are being bought in non-dollar currencies, and then they are settling any imbalances in locally produced goods, right? So if I'm Saudi and I end up with renminbi in my pocket from selling oil to China, and last November, China and Saudi signed a currency swap arrangement, I can then use that renminbi to buy Chinese goods because China's the factory for the world still. And anything I have left over is Saudi. I can't buy Chinese government bonds in any real way, but I can buy gold, and I'm happy to do that. And so as you have more and more of this gold recycling trade, as Curry called it, happening, you're seeing, the issue is that oil markets alone on an annual U.S. dollar production basis are about 12 to 13 times the size of the gold market in annual physical production terms. So oil market alone is way bigger than the gold market. Then you layer in the gas market and the copper market, the nickel market and the coal market, and iron ore, so on and so forth. What you end up with is a whole lot of commodity net surpluses bidding for not a lot of physical gold. And you're seeing these gold flows happen. We've shared with clients a significant increase in gold flows from Switzerland to Saudi Arabia over the last 2 years, for example, and into the Persian Gulf more broadly, very significantly, as this recycling trade's happening. And so it's really just a function of, trying to fit 12 pounds of oil net surpluses into a 1 pound gold bag, that 12-to-1 ratio in terms of relative size. And as they try to do that over time, we've seen, gold go from 8 barrels an ounce in 2008 to 38 or 39 barrels an ounce today. And I think over time, it's going to go to 100 or 150 barrels an ounce, maybe higher. And I think it's mostly going to come from gold rising because ultimately U.S. shale has a hard time keeping production flat, much less growing at too far below $70 or $65 a barrel.
Okay, Luke, let me see if I have all this straight, because if I'm assimilating what you're telling me correctly, we are currently issuing about $500 billion per week of new U.S. Treasury issuance. But if you get concerned about that, the answer is, oh, don't worry, that's just a gross number. If you net it down, because of all the borrowing that we're doing, the number's much smaller than that. And if the person asking the question says, well, but what if you couldn't borrow because nobody wanted to lend to you anymore? The answer to them is, oh, you don't understand. That could never happen to a government like the United States. Then when we look at the measure of when that really could happen to a government like the United States, which is the gold-oil ratio, as you've just described, that's the measure of the health of the petrodollar recycling system, and it's looking really, really bad. And as we talk about energy, and you say, okay, well, the energy is really critical to this. Guess what? Sam Altman just went and lobbied the White House to try to get them to support building 5 gigawatt, not 5 times a 1 gigawatt, but individual data centers that draw 5 gigawatts of electricity continuously. That's more than the electric demand of several sovereign nations. Really, really huge electric demand, and Altman wants to build several of them. Meanwhile, Microsoft reportedly just paid maybe as much as $100 per megawatt hour for a 20-year contract to support the restart of the 3 Mile Island nuclear plant. Luke, this all comes together and paints a picture to me that says we're going to have an energy crisis and we're not going to be able to pay for it. And it sounds like the escape is the price of gold. Am I missing something? Is it really that simple?
I think in very black and white stark terms, I think directionally that's right. I mean, I think ultimately the U.S. government isn't going to have a problem financing this gross number because the regulators have classified the T-bills as regulatory capital, right? Which is brilliant. So they're going to keep issuing more and more at shorter and shorter durations. And they're going to be able to roll all they need because not only that's debt on one side of the ledger, but it's a collateral to leverage up on the other side of the ladder for Wall Street and the financial sector. So they can keep that going, which is fine. However, the release valve is exactly what you intimated at, and then ultimately gold. But what you intimate at is in terms of energy. So now if I'm Saudi Arabia or I'm Russia or I'm any major energy producer, I'm looking at this going, okay, their role, they can do that. And they're doing that because they're classifying the government debt as collateral, which is fine. They have that's their prerogative. But I don't have to store my energy surpluses in that same debt, supplies of which have gone from 100 billion a week on a gross basis in 2013 to 200 billion in 2018 to over 500 billion here in 2024. The compound annual growth rate over the last 11 years has been 15 to 16% in terms of the gross roll. Again, that is fine. That is not problematic for us looked at very narrowly. For the foreign energy creditors of the dollar system, OPEC, that is a huge problem. I can't store my limited reserves in paper whose roll is growing 16% CAGR for 11 years. I would be a fool to do that because at some point my oil well is going to go 100% water cut. I'm going to be sitting on paper whose supplies are growing on a gross basis at 15 to 16%. And when I go 100% water cut, I'm going to have to go use that paper out in the open market and have to buy back oil for my own people at a price that's way higher. I'm better off just leaving the oil in the ground and not buying it. And that is not a good thing for the global system either. And so as a result of that logic, that primrose path of logic, what we are seeing are those nations saying, okay, America, you don't want to cut your spending, your prerogative. we're not going to buy long-term paper, our prerogative. You're going to roll it all at the front end with fast money, hot money, 400 billion of holdings in the Caymans, etc. That's fine. That's your prerogative. That's going to add inflation, also your prerogative. But our prerogative then is we are going to store our net surpluses in gold. And as a result, gold will, in my opinion, continue to rise against the dollar, oil, Treasury bonds. And critically, if you look, interestingly, gold is actually global stock markets around the world, even the S&P, are starting to roll over versus gold, it looks like. And I think in the next 2 to 3 years, I think we're going to see gold outperform even major developed world stock markets.
Luke, as always, I can't thank you enough for a terrific interview. But before I let you go, please tell our listeners a little bit more about forestforthetrees.com, what people can expect to find at FFTT-LLC.com, how they can follow your work, and generally what you do.
Really, we aggregate a large amount of publicly available data in a unique manner to try to help our clients outperform. And FFTT-LLC.com is the website. You can see, learn more about our institutional and mass market product offerings there. And for updates on what we're up to and thoughts, I've got an active X feed as well at Luke Gromen, LUKEGROMEN.
Patrick Ceresna and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, great interview with Luke Gromen. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the button over Luke Gromen's picture saying looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA printed a great big 3.9 million barrel build on crude oil inventories and another 1.1 million barrels of gasoline builds. The only drawdown on the board was distillates drawing down 1.3 million barrels for a net petroleum build of 3.7 million barrels. Cushing, Oklahoma, building 840,000 barrels, still holding just barely above operational minimums. U.S. production ticked up 100,000 barrels to 13.3 million barrels. There's a major tug of war between the bearish view, which is, hey, look, there's plenty of spare capacity, and OPEC Plus is staying the course on increasing production starting at the end of the year. So there's plenty of room for much lower crude prices. And then, of course, the bull argument is, yeah, but that's all true, except the Middle East is about to blow up, and the sky is the limit, with $250 plus on crude oil being not the slightest bit out of the question in certain geopolitical outcomes that haven't happened yet, but the setup is looking awfully rich. So needless to say, fasten your seatbelt, folks. Oil volatility in either direction could increase considerably from here. In terms of the ultimate outcome or resolution to that tug of war between the bull and bear cases, my expectation is that continuing geopolitical escalation is going to lead to much higher oil prices, and that those higher oil prices will then later be sustained longer term by the structural supply-demand imbalances that are projected by JP Morgan and others to come into play in the oil market by 2027 at the latest. But a trip down to $40 before we ultimately rally north of $200 is entirely possible. So I'm not making any long-term bets now. When oil volatility calms down a little bit, I'll start accumulating out-of-the-money call spreads on long-dated futures in the late 2020s. But right now, I don't think that directional bets make sense unless it's a short-term bet based on some understanding of where the geopolitics are headed.
Eric, I couldn't agree with you more that spare capacity has been dragging this oil market lower. On page 2, we have the chart on crude oil, and that persistent pattern of lower highs and lower lows in the downwards channel has been uninterrupted. And even this little short squeeze that happened based upon escalation of geopolitics hasn't really broken the trend. We can just draw a trend line along all the previous highs. You can see that 50-day moving average. We haven't yet seen anything indicating that a new bull cycle has begun. But the geopolitics create a very interesting situation because most traders currently are positioned short crude oil. When we take a look at trader positioning, almost all CTAs are essentially short crude oil because the primary trend following techniques are all still indicating a primary downtrend. Then when you take a look at the number of hedge funds bearish NYMEX oil, we find them very short the crude oil contracts. You then take a look at managed money short positioning. It's almost at a decade high. Now that in itself doesn't mean that oil has to reverse because of that, but clearly when we look at how everybody is positioned, where is the pain trade? Well, pain trade is if the geopolitics escalate and many of these traders are being forced to cover those shorts, we could have a liquidity-driven short squeeze rally that has nothing to do with spare capacity. And so the bigger question, are we witnessing something creating a feedback loop that actually drives that short squeeze? That's the thing to watch. What I would certainly be interested in is to see whether crude oil can get above that $72, $73 area. Then it would be forcing higher highs, breaking above the trend lines, breaking above the moving averages. All sorts of signals to stop the positions out would be flared, and then you would have potentially oil shoot up to even $80, $82 purely just on that liquidity shift. On page 3, I have the crude oil volatility index you suggested. And this is the tricky part because buying long gamma options here, like you suggested, is rather expensive. And we are now at multi-year highs in terms of volatility premiums on crude oil. And this obviously would be more favorable for buying options if this came back down below 40 on that upper range. But clearly we can see that right now option premiums in the crude oil markets are commanding lots of volatility premium. Let's move on to equities. Eric, what are your thoughts here?
Well, so far, this tape action borders on boring. We just rallied to an overbought condition on the S&P, and now we're starting to consolidate, with E-mini futures trading just below the short-term moving averages as of early on Thursday morning. But markets hate uncertainty, and my prediction is that between geopolitics and the U.S. election being only a month away now, we'll have no shortage of uncertainty for the next few weeks. So I think anything is possible here in either direction, depending on the news flow.
Well, Eric, that news flow is right and starts with the jobs numbers coming out tomorrow morning. Now, if they come in line, it may not be a market mover, but if there is a jobs miss, that could certainly spook the markets that the Fed is onto something and there's a rationale behind those rate cuts, and that could spur a distribution cycle kicking in. But really, all eyes turn to the earnings. While everyone has an expectation of earnings growth and the guidance to continue to indicate that, if there's any indication that a slowing economy is going to start impacting earnings, I think that is actually a big factor that could drive a market reversal. Now, I'm not predicting any of those things happening, but I think those are the kind of inflection points that will be worth watching as we go into these elections. Now, moving on to the levels on the S&P 500, with the VIX at the 20 level and the S&P at this 57.43 at the time of recording, it implies a 1 month range of 330 points, which is basically an S&P upper range around 6,075 and a lower range around 5410. Now, the market here is certainly pricing some volatility going into these elections, but will be really interesting to see whether that volatility contains at the 5,600 support line. That's where the 50-day moving average and the 50% retracement of the September rally lies. The way I look at it is the bulls have been and continue to be in control of the price action. Higher highs, higher lows, dips being bought, primary uptrends not being violated. This trend is in place, and to me, the market staying above 5,600 will continue to confirm that. A break below 5,600 would be the first warning signs of a potential topping formation, and that would essentially mean that the markets are getting heavy, with the fact that the NASDAQ and the Russell have failed to break to higher highs, and as well on some of the global developed markets like the Nikkei and the Euro stock also failing to make it back to their previous highs. The market may be actually still creating a bigger topping formation, with only the S&P 500 being able to temporarily break to these higher levels. Will this become a very heavy market going into the elections and in the post-election period? This is certainly one of the puzzle pieces we're going to have to solve. All right, let's move on to the dollar. What levels are you watching here, Eric?
I've been watching for a daily close below 100 or above 101.5. That's the level that we haven't traded above since August 19th, but we just popped our heads above it on Thursday morning. Let's see what happens. If we get a sustained rally here, and I think it will probably be short term because I don't think that the bottom is in for the dollar. But if we can break above 101.5, it might mean that there's a counter trend rally beginning that could take us up for a while before we ultimately move lower. If we see a daily close below 100, that would be the indication that that's not going to happen and that the move to the downside is going to continue without that counter trend rally. Let's see what happens, though. I have a feeling that maybe we're about to see some counter trend action here.
Yeah, on page 5, I have that US dollar index. And what we see is now a pretty distinct reversal off the lows. Was that a double bottom? We're breaking the neckline of September. It's really being driven by a euro weakening. And that's actually going to be critical. The euro remains the largest weighting in the dollar index. And if we see that the euro can't hold the current support lines, then we could see the dollar index head back to 103, 104, which would be a break of this downtrend that's basically been in place over the last 3 months. Right now, definitely showing signs of short-term consolidation and the exhaustion of the selling cycle that was already in place. So will we get that mean reversion back to 103, 104 is actually something I think is quite possible here. Eric, let's move on to gold.
Well, I remain super duper bullish long term. But look, this market has been way overbought for at least 3 full weeks now. And despite being overweight long gold, my strong hope is that we'll see at least a pause in this rally, if not a meaningful correction or pullback before the market resumes. And I say that just because I don't want to see this gold market go parabolic from here to where we have to worry about a blow off top and a major reversal to the downside. I think a healthy bull market needs to consolidate and correct from time to time, and we need that in order to protect the strength and integrity of this gold market. So I'm actually keeping my fingers crossed for not too much more excited upside too quickly in gold, because I might have to sell it if that happens, and I don't want to do that. There's a huge geopolitical premium in gold right now as well. And all it would take is just a temporary cooling off on either the Israel or the Ukraine conflict in order to set the stage for a downside correction of $100 or more. If that happens, I'll be buying hand over fist, and I definitely think it's a conviction buy.
Eric, I agree that staying long-term bullish gold makes a whole lot of sense on a macro scale. The bigger question from a technical perspective is, how do these short-term cycles play out? 2,700 was an upper target zone for me from a technical perspective. And this is a point where gold could reach a short-term exhaustion point and consolidate. That doesn't make me bearish, doesn't make me short, but rather gold does these things where it bursts higher and then consolidates for a couple months. Are we approaching that kind of an inflection point? I think that even if we did see a short-term consolidation in gold, it should likely be contained to 2,600 or 2,550, and therefore I would be buying old dips on any type of a gift if they gave you a quick drop like that. I've currently hedged up some of my gold holdings with the profits being made, and at this stage, while I remain bullish and primarily long, I'm doing so on a hedged basis. Now, moving on to page 7, I have the chart on silver. Now, gold has been ripping to 2,700 on the upside, but silver has just managed to make it back to its May highs. The big question and puzzle to solve here is, will silver have enough gas in the tank to break to a fresh new high? This is pretty significant because when a stock breaks to a 52-week high, it usually creates bullish follow-through that can continue. And if we did have that break of this $32 level, I don't see any reason why the completion of a measured move up to the $34 to $36 area can't complete. Now, moving on to page 8, I have the copper futures chart, and I just wanted to highlight the fact that copper has been holding up very well. We've obviously been in this 4-month bear market where copper consolidated downside, and now for the first time, we've spent almost a month trading back above the 50-day moving average, very reminiscent of the March and April period earlier this year. The bigger question, can all consolidations be kept above that 50-day moving average and be bought on dip? At this stage, the levels to watch are all around the 430, 440 areas. Any quick dips down 20, 25 cents on the downside would be buy on dips, and we'll be watching whether or not continuation patterns that push copper back to its May high get in place. Now, moving on, I wanted to touch on natural gas. Now, rather than using a continuous chart, which is rolling up the term structure, making natural gas look more like it's in a bull trend, it really is just simply rolling up into winter gas prices. I think that looking at the strip is much more effective. So I have a chart here of the natural gas 12-month strip. And what we can see is that after a 2-month sideways consolidation along the lows, we're seeing the first period of an attempt to turn the trend back bullish on the upside on the entire strip. The big question is, will this lead to some follow through? Obviously, weather will be a dynamic going into winter, but at this stage, it is at least trying to bullishly break out. And if this follows through, maybe we will see June prices again. Now let's move on to uranium. Eric, what are your thoughts?
Well, Patrick, with Cameco trading over $50 on Thursday morning after having traded as low as 37 a week or two ago, it's finally looking like, barring a broad market liquidity event, the bottom is probably in now for this long correction in uranium mining shares. But the brisk upside reversal left plenty of gaps in the charts well below the current market. So there's plenty of room for an air pocket to take us back down to fill those gaps. And if that happens, it's definitely a conviction buy. The fundamentals couldn't be more bullish generally, and Russia appears to be about to ban export of uranium and enriched uranium products to the West. Now, I do want to express one word of caution about that, because I hear a lot of people in the uranium world jumping for joy saying, oh boy, if Russia does that, it's to the moon for uranium prices. Well, hang on. It might not be quite that simple, because Russia doing this, more than anything else, is going to have the effect of really taking Russian enrichment services offline. So we're not going to be able to access enriched Russian uranium from the West because of Russian sanctions against the West. Is that a big deal? Yeah, I think it actually is a big deal. And the reason is that we're very dependent on those Russian enrichment services. We don't have enough enrichment services in the West to support ourselves. And without Russian enrichment services, and remember that without those Russian enrichment services, you have to think about the supply-demand fundamentals for the uranium a little bit differently. Let me share a story from early in my crude oil trading days. This was more than a decade ago. I remember a really big storm headed into the Gulf of Mexico. And as a pilot and a sailor looking at the weather charts, I was convinced the weather was worse than the market, the oil market was discounting. The oil traders were not as concerned about the weather as I was. So I went long oil into a weekend that a big storm was going to hit Houston. And sure enough, on Sunday evening when the futures market opened, it was up huge because of the massive storm surge causing all kinds of flooding in Houston. And I looked at the big gain on my trade and went to bed on Sunday night thinking I was a genius. I woke up Monday morning in absolute terror, looking at a huge loss on my account. Well, what happened was the dumb speculators like me who didn't really work in the physical market and didn't understand how it works were making those speculative trades on Friday afternoon and Sunday evening. Then the big boys who actually work in that market came to work on Monday morning and said, these floods are going to take 3 refineries offline. That meant that end products, RBOB gasoline, was absolutely crazy upside to the moon, while crude oil was straight down, because with the refineries offline, they can't refine the crude and they don't have a place to store it, and that creates a backup. Now, with uranium, we don't have the physical challenges of storing crude oil, which is very bulky in large tanks. So the running out of tank space is not a factor in uranium the way it is in crude oil. But I still think there's a risk here that there could be an unexpected twist to this Russia story where everybody thinks it's going to be upside for uranium prices. It turns out that it ends up squashing raw uranium demand, because effectively it's the refiner as opposed to the source of the raw material that's been taken out of the equation. So let's keep a close eye on what happens with respect to that. I don't think many analysts are looking at that particular nuance of this Russia story.
Well, Eric, the uranium has been in an 8-month consolidation. It's been a pain point for a lot of the people that have been very bullish. But we're now, for the first time, seeing some accumulation, positive price action, good flows. This could be a trend shift. We're going to be watching closely whether a new bull phase has begun. Clearly, some of the individual names like Cameco or the URA as a broader ETF have really come to life. There'll be certainly money flow coming into this space, and we'll see whether or not this 8-month correction is finally behind us. I wanted to wrap things up here, Eric, by looking at the Bloomberg Commodity Index. And what we've had is a 2-year bear market in commodities when looking at a broader basket. But there's been divergent momentum for the last year. And there hasn't been any aggressive sell cycles that really followed through. And that really begs the question as to whether or not we're going to see, particularly driven by the new China stimulus and a lot of the money pumping in, will we see finally commodities come to life? We certainly on the short term have seen that over a few weeks, but the bigger puzzle to solve is that does this now create a new 6-month or 1-year bull trend? I certainly think it's on the table and is something that I'm going to be watching closely with my members. Finally, I wanted to touch on U.S. 10-year Treasury yields on page 12. Now, we have had an epic bond run as yields collapsed all the way down to 360, and now it's consolidating. It's consolidating into tomorrow's jobs numbers, and this will be the interesting thing. Obviously, if there's a bad jobs miss, then we could see yields drop again as bonds break out, as confirming that we're heading toward a recession. But if the jobs numbers come in line, we could see continued consolidation toward 4%. This was a huge overshoot and a big move, and some consolidation back to midpoints of the ranges, and the market starts pulling out 2 or 3 rate cuts is entirely possible.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview and the chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. So that does it for this week's episode. We appreciate the feedback and support we get from our listeners and are always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share their content with our listeners, send us an email at researchroundup@macrovoices.com and we'll consider it for our weekly distributions. If you have not already, follow our main X account at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. And you can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.